Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Trading convertible bonds on emerging market underlyings in the pre-GFC period, Vishnu Kurella quickly learned that even indices can experience enormous daily moves. A macro portfolio manager who evaluates opportunities through the lens of optionality, he shares the lessons learned from trading through the frequent episodes of crisis that characterize modern markets. In this context, Vishnu emphasizes liquidity and the implications for being able to unwind trades without excessive friction. In his rendering, open-mindedness is also a critical part of the risk management process. Here it becomes important to continuously look for shifts in the macro risk regime and to be prepared to re-underwrite existing exposures as appropriate. From here, we jump to considerations in trade implementation and seeking to overlay an expected distribution of outcomes relative to that which is implied by option prices. Lastly, we talk as well about the current climate, one in which equity markets have been punished by inflation and Fed policy uncertainty. Vishnu shares his views on the pressure points, noting the incredibly favorable environment for corporates in 2021, in which both base rates and credit spreads were extremely low. He sees something considerably more fragile now. I hope you enjoy this episode of the Alpha Exchange, my conversation with Vishnu Kurella. My guest today on the Alpha Exchange is Vishnu Kurella. He is a specialist in macro through the lens of volatility. Vishnu, it's great to have you on the podcast.
Yeah, hey, Dean. Thanks a lot for having me on. I'm really honored you've had so many brilliant minds on this. It's pretty humbling to partake, so thanks a lot.
Yeah, we'll have a great time going through your career history. We'll talk some historical vol events that we've both traded through, especially through the derivatives lens. It'll be interesting to get your take. And then we'll talk about the here and now, this almost outrageous set of market prices that we stare at these days. Before we dive into that, let's learn a little bit more about you and your history. How did you happen upon the wonderful world of high finance? How did you get your interest and your start?
Yeah, I guess a bit of a happy circumstance that I grew up in Chicagoland. So in my high school, my econ teacher was actually a former currency options trader. And he would kind of regale us with stories of trading dollar yen mostly, if I remember correctly. And there's even like some trading simulations in class. And that sort of planted the seed for me. I was really focused on medical research. But when I got to college, it was late 90s. And that was sort of the time that investing and trading in options became really accessible. I think, first of all, you were able to get information over the internet and it was just disseminated much more quickly than, any time in history. And then secondly, commissions had come down. I know nowadays stock trading is free, but back then I think it went down from like $50 to $8 with E-Trade and Ameritrade and everything like that. And so you could actually trade options. So at that time, it was very exciting. It was all about the NASDAQ. And I was actually trading options from my dorm room with a good friend. We started the Rice Online Investment Club and were able to actually get sell-side research for free because we're an educational institution. So the trading, it was fun. It didn't go so well, which shouldn't really be surprising. But I didn't lose money for the reason that you expect. I actually got really bearish in late 99 just because things had gone so far. But I bought a bunch of put options, an embarrassing amount of my portfolio went into put options. And the problem was that they expired in January and February of 2000. So I learned a very important lesson very early in my career, if I can call it that, in that you might have the right view, but if your timing is off, then you're wrong. You're going to lose money, especially if you're dealing with options. And I think it's human nature to really focus on setbacks in your history as opposed to successes. And, that still stays with me today about, staggering my maturities and making sure that, I'm not too exposed to exactly the timing of when I think something might occur. And, it's coming out of that, even though I ended up losing money, I got excited about trading. At the time, it seemed that the right course was to go into iBanking, and I quickly realized it wasn't the right fit for me. And I was lucky to end up on the buy side very quickly. So thankful to HBK for giving me a shot with no experience. And I joined the Convert desk in Dallas. And I started the same month as sort of the bottom of that market, March 2003. And it's interesting because so much of that sell-off, kind of 2000, 2003, is similar to the current situation we're in now. And for the last 20 years, we really haven't had an extended bear market. That was sort of the last time I remember waking up every day and thinking that the default direction of stocks were down during those 3 years. So anyways, was pretty fortunate in '05 where I was managing some risk in the international convertible portfolio and really out of mostly luck had positioned well in Japan into Koizumi, privatizing Japan Post and all the reforms. And I was trading converts, and the best situation for converts is really spot up, vol up. And that's exactly what happened in Japan. And it's pretty rare in the US. Obviously, we've seen some of that in the last couple of years, but in Asia, it's much more common. And that ended up, really supporting my ascension into becoming a portfolio manager. And I moved out to Asia. I had always been jealous of the folks who had traded 99, 2000 in the US to catch the big bad US bull market then. But I was fortunate enough to make it and see it in person in Asia. '06, '07 in Asia was very similar, I think, in a lot of ways to the late 90s in the US. So it was a very good trading experience to be there. And then obviously 2008 was dramatic across the globe. When I moved back to the US in '09, ended up joining Blue Mountain a little bit after with a focus on purely equity and FX. And I think that, the shift I made watching all the macro events unfold in '08 was that I really wanted to focus on macro. So I gave up really the single stock analysis component of what I was doing and really focus on, high level equity derivative vol and FX vol. That was a great opportunity. And after a few years, I came to the conclusion that if you use a log normal distribution assumption for your trading, you're pretty limited in what you can do. And ultimately, it's very competitive to have the best vol model out there, the best quantitative approach. And it was really kind of 2013 that opened the door for my real interest in macro and how I wanted to pivot. And that was the year where if you just traded US equity vol, it was actually quite boring. I think the S&P was, close to a 3 sharp. And of course, that was the year of the taper tantrum. So trading volatility in EM assets was infinitely more interesting. But the real story of the year, I thought, was Japan again. And, being able to take large positions in a market like that, unlike a lot of the EM nations, really afforded a huge opportunity. And it was one where if you just used quantitative analysis, it certainly wasn't compelling and it might have driven you to take the opposite position. But you really wanted to have vol in Japan that year just because of the significant macro change. And, my 2005 experience actually served as a really good playbook for how to think about it. So at the end of that year, I decided that instead of just trying to become a much better vol trader, I wanted to really improve my understanding of the distribution. How is the distribution of the underlier actually different, from what the log normal assumption is? And I think to think like the best, you want to learn from the best. And so I joined Caxton, which is a longstanding global macro fund. So there, I was able to kind of be in the room with some of the best minds in macro and understand how they approach their decision making. And I think that it's very tough to be in the top 1% of a single skill. So my thought was, if I could be really good at 2 different skills, the overlap of that would put me in a very high percentile for what I'm trying to accomplish. And, that's been my goal since 2014, is to really improve that macro skill set and have an understanding of, where the distributions can be mispriced and really how you get large moves. I like to think a lot of vol trading, works if history repeats itself, because the number one thing you're looking at is the backtest and how things have worked historically. Whereas macro really works when, things are changing, right? When you get that big move in a single direction because of a policy change or a shock, that's really when macro strategies work. So it's a great combination.
Let me just jump in, and you've got a couple of things there that really piqued my interest and I thought we could explore more. And you point to this idea of the log normal distribution of prices, returns are normally distributed. It all fits beautifully into a model. And we know that, asset prices are not that. They don't move that way. And so you also mentioned trading converts in Japan. And my question is just around modeling converts, the kind of idea of trying to get to the actual distribution, perhaps whether it's about the vol of the stock, credit spreads, the interaction between vol and credit spreads. But then there's this other part of convert analysis, which is a bit more of being a careful reader of the documents. It's trying to pick apart those embedded puts and calls. Maybe it's div protection, maybe it's takeover language. How much of that was a part of where you found value in the convert universe in Japan during your days trading converts back then?
Yeah, I think it was much more of a requirement in the US. I think what you said is sort of spot on. If you wanted to make 5 to 10 points on something, it was very challenging to do that, based on the standard model. It was finding something like you're talking about. I think, the takeover was a big deal if you're selling calls against your long convert position, or if you had like an averaging period, in which case, if the stock moved in one direction, then, you had free optionality. I would say in Japan and definitely in the rest of Asia, it was a lot more of actually traditional arbitrage that worked. It was less document dependent and more that, that was actually where the opportunity set still was in the middle of the 2000s, whereas the US market was a lot more efficient.
And you, of course, if it's the pre-crisis era, you had vol globally really smushing down to lower and lower levels. What was the evolution of pricing, the sort of implied vol equivalent of pricing in the convert market? What did you observe during your period there?
Yeah, I think that you had, especially in emerging markets, right? So the most interesting product to trade and where there was still value from a quote unquote R perspective were the cross-currency converts in the real emerging countries, right? So say India or Thailand or something like that. And here you were able to get not a perfect hedge. In India, there were single stock futures you could use, but really it was sort of index level hedges. So you're running a basis. And in this case, you were buying implied vol in these single names, around between like 18 and 25, which for a single name in emerging market was extremely low, right? The real question was, okay, how do I actually hedge this properly and feel comfortable with the basis risk? The best trades are the ones where you could actually get an asset swap or you had some type of credit protection and you could really focus on the vol. I remember Thailand in the middle of that decade, there was a day where there was a military coup and the set 50 was down 20%, limit down. Okay. And, I had some set 50 futures I was trading in and out of. And then the next day, the government said, no, we're actually going to maintain the same policies. And then it was limit up 20%. Right? This is the index. This is the index of the country. So it just kind of goes to show you like how violent, how much more violent emerging markets can be.
Yeah, for sure. You can see just giant moves. And it's actually quite interesting to hear the kind of implied vol on a single name in EM in the low 20s. It just tells you just how low risk premium was across the world during that time period. So let's walk through the financial crisis, maybe some big picture takeaways there. And then I just want to really learn more about this. We'll call it a switch, but it's the evolution of your career where it starts with vol and then it goes to macro. I think a lot of people do the opposite, which is there are macro specialists who ultimately incorporate some version of vol into their process. And you've kind of gone the other route. You've started with vol. You've gotten a lot of training in very vol-centric shops like Blue Mountain, and then ultimately gravitated towards a more macro-centric framework, and I'm sure incorporating a lot of what you learned on the vol front. So let's walk through maybe some lessons from crisis events. Maybe it's 2008, maybe it's Eurozone from 2011. What are the lessons from that period of time from a vol standpoint?
I think the best takeaway from 2008 that's not specific to that year was simply that you have to be open-minded to what could happen. I think going into that crisis, everyone wanted to believe that subprime was contained, but even going into the days that Lehman went under, I think most people believed that Lehman would get bailed out. And I think that, one of the best mentalities you can have in macro is you have your base case view, but then you're open to other paths occurring, right? And you're paying attention to indicators, to price action, to data, anything that may invalidate your base case and actually directs you to a different state of the world. And I think the faster you can pivot, I think one of the beauties of macro is that you can really shift your portfolio very quickly. The faster you can pivot, the more to your advantage that is. So that's really what stood out to me in 2008, outside of, the very specific nature of the credit crisis. When you walk forward to 2011 or even 2015, I think that, one of the most notable things to me there was that equities as an asset class moved quite late. I think that there were a lot of signs in both years, both from data deterioration and credit really widening, that gave you a lot of clues that equities really could take a big leg lower. I think that in each case, people sort of associate the drawdown with a specific event. In 2011, I'm talking about the US side here, was the debt downgrade. And in 2015 was the quote unquote China devaluation, which was a few percent. But whereas there were a lot of signals that, things were deteriorating under the surface. And I think that, paying attention to financial conditions is really important. Nowadays, it's part of everyone's lexicon. I guess even the Fed, Fed speakers have been targeting financial conditions. But, before this year, something that I really appreciated as an area to follow closely. And I think that's something you pick up from the macro side. And my approach is that if I'm evaluating financial conditions from an equity perspective, I don't include equities in the index. Because if equities are rallying and that's softening financial conditions, I don't think that makes it a positive for equities to keep going up. So I sort of eliminate the asset class I'm focused on and look at the balance. And I think it's very important as a leading indicator to really just the liquidity in the system and what could go wrong. Obviously, this year, it's been a very specific focus of the Fed to try to reduce inflation.
Risk management is about realizing that you might be wrong and constantly, in some ways, second guessing yourself. I think Stan Druckenmiller frames it well. He says, we study these markets, we try to get every last data point we can, and we realize we know 20% of what we want to know, right? There's 80% that we still don't know. So you're making judgments amidst vastly incomplete information. And so I like the way you frame that. And it just got me thinking, especially as we talked about some crisis events and these lurches to illiquid conditions. My sense is over the years that some of your trade construction has used OTC instruments, perhaps variance swaps and the more light exotic type of trades. These are the trades that during the real good times, they're quoted in good size. They're pretty liquid. And when things get disrupted, all bid offers widen, but some of the OTC product can widen a lot. And that's my question, is just in terms of risk management, how do you think about the portfolio that you have on and say, how do I convince myself that if I needed to, I can unwind what I have on in an acceptable time frame at an acceptable level of friction?
Yeah, that's a great question. I think actually it reminds me of another takeaway from the GFC. And I think, one thing that's interesting, if you have a portfolio of variance swaps, say, and they have caps, there's not really a good implied vol-of-vol parameter in the marketplace that you can use, right? And I think that an index, it's possible that there's some marks, but for singles, there's nothing really that's that great. And if you're on the buy side, you're a little bit at the mercy of the bank that you're facing as to how they're going to mark that, right? And so let's say, for example, you have a dispersion trade on and you're long single stock variance swaps. Essentially, you're actually short that vol-of-vol with the cap relative to an uncapped variance swap. So if your counterparty actually marks up the vol-of-vol, then you actually take a mark-to-market hit, even if the actual base level of vol doesn't go down. So features like this are, very concerning if you have a lot of exposure in OTC. There's no question. I think that you have to have really good documentation, and I think that it's important to, negotiate the ability to challenge when you need to. But ultimately, it's about sizing, right? And I think that so much more of the market has gone to listed in the past few years, and I think that you have to be aware of how bad something can get on the OTC side, because you don't know when you'll get caught off guard if a bank decides to, mark to model something with very different inputs.
Yeah, it's interesting. I just am recalling the advent of single stock variance swaps, and I'm going to put it at around 2001. This was a high vol period. Certainly 2002, we were starting to trade them, and the cap really came out of nowhere. It was a real made up sort of thing. We experimented with an actual hard level, and then we just came up with 2.5 times the strike. It was reasonably random, and it was, I think, viewed as sufficiently far out of the money that it was kind of harmless. It was sort of an unpriced cap, for better or for worse, probably for worse. But, it set itself up, I think, from a margining standpoint, because you certainly don't want to be short a single stock variance swap in the last days of the existence of a company like Enron. I think the realized vol might have been 700 or 800, the last week or so. So the cap was really a credit margining issue more than anything else, but it was really random, the way in which it sort of came to be and accepted by the street. So you were at Blue Mountain for a number of years, and then you made this moved to Caxton, as you said, to really sit amongst a room of very, very global macro-minded folks who had a lot of expertise in that area. Talk to us a little bit about that transition and maybe bring to life for us some of the differences in your day-to-day, and not to be very specific on the two firms, but just in terms of the style of analysis.
You have a series of firms or strategies that are based on hedging a lot of risks and isolating a single alpha component. And at the same, convert arb may be the best example of that, right? Maybe you're buying a convert, you're hedging the credit, you're hedging the vol through options, and you're trying to isolate some cheapness. And then you have macro funds who actually, they just want that singular exposure, right? A position may be long a yard of dollar yen, and that may be how they're actually determining their alpha component. So the sort of implementation of the structure is so different. I think the second is, in Paul Tudor Jones in his amazing 1987 trader video, he's got that sticker behind him that says losers average losers, which, it's always interesting to me that, from a macro perspective, the best PMs are always sort of on guard about needing to cut positions, having stops. Like if the world is different than they think, I need to get out. Whereas if you think about fundamental investing or multi-strategy hedge funds, the usual mantra is I'm going to have a scale where if it goes against me, I'm going to add. And if it starts making money, I'm going to reduce, right? And if you believe, for example, that vol is mean reverting, then you're going to employ somewhat of a similar strategy. So I grew up in that mentality. And so starting at a macro fund, it was very different, where if the trade's not working, it's expected that you cut it. And I think that's a very different mindset. And at this point, I've actually decided to employ two different frameworks for how I trade mean reverting strategies and how I trade macro, because I do think that, each side has it correct for what they're trying to do.
What you said there just got me really thinking about this idea, especially for folks, and this is going back a ways, and perhaps we've just learned a lot, or the markets have taught us a lot along the way. But in the old days, and I'll go back to late 90s, early 2000s, if someone was starting to establish, let's say, a short variance position in index vol, so just being short S&P variance, it paid very often, right? And typically you could just ride it out. Of course, crisis events made that much more difficult, but I would just recall as clients started to scale into these trades, and they'd almost be wishing it marked against them early, right? But you have a chance to average in at higher levels. And I think that even for vol accounts, I think there's just a different mentality. As I said, maybe the market has taught us these lessons. How would you think about that? This idea that from a short vol standpoint, you can just try to get bigger and just average in. Do you feel like it's just a different way of trading these days, that you've just got to run it a lot tighter because the mark-to-markets can do strange and sometimes awful things to you?
Well, maybe not just mark to market, right? I mean, realized vol was very high in 2020. If you started adding, as it was going against you, you weren't going to maintain that for very long. I think that, you have to assess the situation maybe, right? And I think that's where sort of making a call on the macro climate is important. I think that, there's a lot of examples where the market's down substantially and vol never picks up. Maybe this year is one of those examples, but for example, Q4 2018, we saw that similar environment. And then you have other examples where, vol picks up very quickly and then retraces because we're still in a friendly macro environment. So I think, part of the question is you're making that call. What's the old joke about vol trading, buy low, sell high, but buy really high? Because if it's getting to a really high level, then something is very wrong, and 2020 being the most recent example of that situation. And so I think that you have to make a call. And I think embedded in almost every vol trade and strategy is a macro view, whether the PM wants to say that or not. So if you've decided that you're going to add to your position as vol keeps going up, you're making a macro call that we're in somewhat of a benign environment.
Well, I want to ask you a lot about your macro framework, and so we can dive into that. I also want to just touch on this idea of the drivers of, let's say, S&P index vol. And as you mentioned, your time in Asia, that's got this very vibrant structured products market. Sometimes these trades in aggregate are so big that they really do impart themselves on the vol surfaces of things like KOSPI. And so there's this just giant market. There's buyers of vol, there's sellers, there's all kinds of folks doing stuff in options. There's this exchange of risk at a certain price across time and strike. And people try like crazy to explain the moves in the market based on the flows, the vol flows. Sometimes they look at things like Vanna and Charm and all these third order Greeks. Does that fit into your framework? How close do you think we can get to trying to understand the, let's say, movements in the indices or the vol of the indices as a function of what's already been exchanged, the trades that exist in the market at a given point in time? Does that fit in to how you explain the movements in the market?
I believe that it's certainly a factor. I think that all else being equal, those, Vanna Charm flows, for example, will certainly have an impact, right? And I think that in a low liquidity environment where people don't have conviction, they're actually going to have more impact, right? When you have, wider spreads and less volume, say bid, ask, and E-minis, then there's no question because those trades have to go through, right? It's similar to vol target funds where if they have to sell, then if there's less liquidity and less people in the market, then they're going to have a much bigger impact when they're selling. So I do think there's a place for that. It's funny that you mentioned structured products. I've traded Euro stocks and Nikkei for a long time, Kospi as well. And, recently there's been a lot more issuance with US underliers. I think if you ask a lot of participants, for some of the reasons for why vol has not performed so well this year and why skew is low, then you tell you the structured products with US underliers have actually had an impact this time around. I think it's finally gotten to the size where it is, making a difference in how vol is performing as spot moves lower.
Well, let's talk about macro. And you'd said something earlier that really got me thinking, which is this idea of trying to identify regime change that we all, especially as derivative specialists, we sort of live and breathe data. We believe in, as you mentioned, some idea of mean reversion. So we utilize back tests. We take them seriously, but hopefully not too seriously. But we also have to overlay this idea that sometimes the future is just going to be different. It's going to change. And you talked about Japan and Kuroda just doing something completely different and it absolutely having profound impacts on the price of vol in Japanese related macro assets. What are some of the big picture changes in regime that have been meaningful to you that kind of form a part of your philosophy of thinking about markets?
Well, I think that I would offer this sort of macro mantra of, policy, profits, and positioning. And, hat to Mike Hartnett, I think he mentions that in many of his research reports. But, those are the drivers, right? Those are the drivers for why you might see a sudden shift, and they're different. So if you think about policy, certainly you have central bank policy, but you also have government policy, right? So the 2016 election, had a substantial effect on the market in many different ways. And, we just talked about Kuroda and, Abenomics falling what Koizumi did in 2005. So you have the impact there. You've seen definitely some of the issues in Europe whenever you have the potential for an EU zone breakup and, who's winning elections. So you have those changes always. And of course, right now, policy seems to be much more about central banks. I mean, you nailed it on the head last year when you said, is everyone asleep at the wheel on inflation? Is it, is it the next subprime? And now central banks are in the spotlight. So, what are their policy decisions? I mean, obviously, we're recording this a few hours after the Fed meeting today, and it's the first 75 basis point hike, in 30 years. And this is clearly the focus right now. So if we go to the other parameters, right, profits, then that's more about the economic cycle. And, can you see when that's turning and what are the leading indicators for that? Obviously, we've had, a pretty smooth sailing in that side of the coin. And, we'll see what happens next year with all of these leading indicators turning lower right now. And then, of course, positioning, it's not really about regime shift. It's more about being able to trade effectively when positioning gets stretched in either direction, really puts the odds in your favor of how you're going to position at that given moment. And I think that, there's a variety of metrics, that can be useful, but generally you're sort of arriving at the same conclusion. If everyone's on the same side, of the ship, then it can obviously tip one way much faster than the other. So I think that, as far as specific regime shifts, I think that they've all just been so different. When the U.S. has a regime shift, it impacts the rest of the world. Whereas I think that if there's a regime shift in a specific country, then you're really focused on, what's going on there, and it's isolated to the markets in that one space. So, either way, I think that having the right macro framework to understand, how this should change the price of XYZ is really helpful in getting ahead of the curve and positioning well for a regime shift.
Positioning is kind of the holy grail. It's trying to really appreciate when things are crowded. That's where you can get real snapbacks. People get out of stuff quickly. It's crowded to get out of crowded trades, right? There's a keyhole effect of people trying to do the same thing at once if they turn out to be on the wrong side of it. How do you get closer to crowding analysis or trying to suss out how crowded something truly is? There's CFTC reports, there's in the options market, there's this people trying to, analyze open interest and things like that. Is there any really good metrics that you found are good indicators for really giving you a sense, or is it just trying to have as much dialogue with market participants and the sell side and to try to understand how things line up?
I would offer that, the most successful techniques, I think, involve a combination of indicators, because one specific indicator, it's tough for that necessarily to have great forecasting powers. But when 3 or 4 things line up, I think it gives you a few data points in history that, might suggest that there's a potential turn, right? And I think it's about, is there a spark that could change the dynamic? And if so, you might have something that wouldn't have affected the market generally, but in this case, it moves it significantly. And I think that when you look back at 2020, right, and we could talk about that for a second, I think that, the dominoes were really stacked. So in the summer of 19, I wrote an article, an op-ed for the Financial Times, talking about how the market was very susceptible to, really once in a decade drawdown. And we just didn't know what the unknown was going to be. And I think you just had so much of this selling that needed to happen that in an environment with less liquidity and all of this positioning so full, that has positive reflexivity to it, right? So if you think of vol control or you think of risk parity, as soon as conditions get worse, then there's a deleveraging component that has to occur. And so I think understanding the capability of that occurring and what might, if you can just see a few steps ahead even, then, really prepares you for what might happen. So similarly, I think, with positioning, I think, one of the things you want to think about is it very extreme, but also I think recently checking, kind of beta of XYZ, to this asset price, right? So you're able to get some listed funds, you can see their performance and you can say, okay, well, the positioning must be pretty high in CTAs or something else with XYZ asset because you're seeing the recent history with the beta.
I think what's so interesting to me, you mentioned the 2020 crisis, and that insurance was there in mid-February to buy for a song. It wasn't 2017 type equity fall, but it was 13 to 15 type of VIX, and credit spreads were extremely tight.
The craziest thing to me, Dean, was that, it started kind of playing out in January, right? And there was a little bit of a drawdown. Obviously, Asia was under duress, and there was no sign of that stress as you got to mid-Feb. It was pretty remarkable, as you say. Just looking kind of how that played out just goes to show you that sometimes markets are just not efficient.
Yeah, and I think it's about trying to appreciate the potential for asymmetry. And I'll tell you, someone who just really stuck out for me and someone I just wound up listening to quite a bit is Mohammed El-Iran. He was really talking forcefully about this idea of, he just called it the economic sudden stop, that, this is a totally different thing. And obviously it turned out he was quite right. It's not to say that anyone can forecast the future. It's just about finding those instances where the risk reward, especially in the area of convexity, right, where you're only staking a little bit to begin with, and the potential outcomes are so significantly in your favor. That's obviously the way convexity works. Well, let's shift to this. Let's shift to the here and now, because I don't know that we're in a market crisis, but the S&P has shed 20% this year. That's a lot. And so we got the VIX in the 30s, so that's pretty high. What are the types of things that are on your dashboard now that that you're kind of looking at? What's top of mind for you in terms of the risk mosaic, so to speak?
This is a quite interesting environment, right? It's hard to have a specific playbook for this because we just haven't seen it really in our careers. And especially, I think Stan Druckenmiller was saying recently, even Arthur Burns, like the risk-free rate wasn't that much below inflation. Whereas now, obviously, the risk-free rate is quite a bit lower than the rate of inflation since it's unique time. I don't envy the position of central bankers right now. I think they're in a very tough spot, and I don't think there's just great answers. The biggest concern to me here is, the effectiveness of monetary policy to actually reduce inflation. I'm just not sure. I think that, we had, and I'll probably get a lot of arguments from monetarists out there, but, we've seen a decade until recently where there was tremendous monetary-based expansion, and we just didn't see inflation. Right? It almost seemed like, they couldn't really generate inflation as much as they wanted to, the central bankers, I mean. So are we that confident that they have the right tools to reduce inflation right now and, in an environment where, it's really gotten out of hand? Hopefully they do. But, I think that's definitely a tail risk. I think ultimately you want to be tracking the things that might force changes in policy, and then also FX rates, which may do the same. I think Japan is a pretty interesting topic right now. We're recording this before the BOJ meeting later this week, and obviously dollar yen has been notable how much it's moved, and it'll be interesting to see if there's a policy shift at this meeting or later in the year. But I think that you have to watch and see where does the pressure point come in for the government there. So I think that the left tails are picking up, and for the first time in a long time, you don't have the central bank behind you. I think in 2000, if I'm not mistaken, in May, Greenspan hiked by 50 bips, even though the market was under heavy pressure already. And that seemed to be sort of the nail in the coffin. But even then, he was able to cut, not so much longer after that. Whereas this time, I don't know. It's hard to guess where the first cut will be in rates. We're not even above the neutral rate yet, so we can't really be talking about that. And I think that creates a unique dynamic where now we have to look for where the pressure points might be in the market. And to me, another one on this list to track is credit. I think that in 21, you had one of the best refinancing environments ever. It's tremendous, right? You don't usually get low risk-free rates with really tight credit spreads. Highly unique. And, that's sort of the best of it. That's the best of it. And I think a lot of companies were able to take advantage of that and term out their debt. And so it may not occur for a while that you're going to see that pressure. But if rates are substantially higher, remember that a lot of these companies have been solving for interest coverage, not for actual leverage like debt to equity ratios. So as rates have gone down, they've sort of piled on more debt because they can pay the interest. So if these leverage ratios are actually high, if they're coming to refi at higher levels, it could be very challenging for profits. So certainly medium term, that's something to look at. I think that overall, there's a lot more fragility in the market than we can really recall the last 14 years. So there's certainly a long list of things that can go wrong here.
You mentioned companies solving for interest expense. I know one very large company that's been doing the same. It's called the United States. All right. We've got a bigger stock of debt than ever before by a ton, and yet the rate has come down. So interest expense hasn't gone up all that much, but boy, when you start to put higher numbers through the cost line from an interest rate standpoint, you get to some pretty scary numbers. I wanted to go back to Japan. This seems to be the holdout. If you look, for example, at, let's say, the swaptions market in Europe, it's not US style levels of vol, but boy, they've been pulled into it as well, right? They're going to be moving much more aggressively than you could have ever really thought. And so Japan seems to be the holdout here. And how should we frame that? How should we think about it? And when you kind of step back and think about global macro risks or spillovers of asynchronous policy, how do you size this one up?
Yeah, look, I think that one interesting point is to combine the two things you said, actually, right? Certainly the US debt stock is high. We have a deficit, but the Japanese debt stock is much larger, right? The second thing is that, most owners of US debt don't live in America, right? There's such a significant amount of foreign holdings. Whereas, again, in Japan, most of the holders of the debt are domestic. So I think it puts the BOJ in a much more difficult spot to actually let rates go up. So I don't know how that's necessarily going to play out, but it's going to have a dramatic effect, certainly. And to your point, there's such a connection between yields around the world that, what the ECB is doing and what BOJ is doing certainly has an impact on US yields. So I would imagine there would be a ripple effect if they change their policy substantially. So is something that you have to kind of be on the lookout for, for the rest of the year.
What are the types of things that are giving you signals on the market, whether they're correlations or, kind of cross-asset metrics that you think are worthy of attention? Take us through what that looks like.
Well, you mentioned correlations, and I think that, something that's really been talked about a lot this year is the stock-bond correlation. And I have a different approach, I think, to many people. I think the common approach is to just look at daily realized correlation between stocks and bonds and say, oh, it's going up or it's going down, whatever the case is. But I think fundamentally, it comes down to what's driving the moves in rates on a given day, right? So if it's a growth shock, then you're going to have a situation where yields are probably going down and equities are probably going down. If it's a policy shock or something from inflation, then you have a situation where yields are probably going up and stocks are going down, right? And I think that it's important to to separate these two outcomes and then assess really where the risks are, right? Are the risks coming from central bank policy? Are the risks coming from inflation? Or are the risks coming from growth? And I think that helps you. And you can look at historical days where these were the drivers and what that relationship is. I mean, I think there's no question that inflation is a much bigger risk than it has been historically. And so that's why it makes sense that this correlation is picked up. And I think an assessment of how the correlation will be looking forward will again be an assessment of whether inflation remains to be a very large risk. I think the same thing about term premium. I think that term premium has been negative for so much of our career because fixed income has been such a great hedge. I think that, if you think back to sort of like CAPM or like gold miner stocks or something that's not correlated to stocks, like, oftentimes this expected return in these models is that it should be lower than equities just because of the correlation benefit. So you could argue that, bonds should be trading rich if the correlation benefit is significant, which it has been for, maybe 40 years. So if that's changing where inflation is now the bigger risk, then you could then argue that maybe term premium should be positive again. And if that's the case, then, it's going to be a little bit more like the previous decades in that sense. As far as the other part to your question, I think it's what's in focus in the market is what I'm trying to pay attention to, essentially. So when you're trying to cover the whole world, there's a lot of different things to look at. And I think the idea is, okay, what is top of mind for the markets today, and make sure that I'm looking at the proper indicators of that. And oftentimes it's not a single Bloomberg ticker. Oftentimes it's the relationship between 2 or 3 Bloomberg tickers. So I have a lot of custom indices where I'm combining things to kind of understand and see beneath the tea leaves. And that served me well over the years.
Yeah, I think you can be creative on these types of indicators. I looked at just the move index divided by the VIX, just let that ratio. And there's nothing, of course, tradable about that. But there was a period where the VIX, one of these counter trend rallies that we had about a month and a half ago, the VIX got almost to 20, and you had the move at 120 or 125, and that just felt like a real disconnect. If you're an equity investor and you think that the biggest risk is interest rate uncertainty, then those two numbers just didn't really corroborate with one another. And it turns out that we had a pretty big adjustment. Of course, the move went even higher, but the equity VIX, it definitely caught up. You talked about option trades, and in terms of, you had this story of having a put option on expired just before the teeth of the dot-com sell-off in 2000. So the timing wasn't there. I'd love for you to talk about trade construction, because it's never easy. You're never going to get it perfect. But we live in a world where most people complain that option prices are too high, right? Even as there's been some bloodshed in terms of being short vol, the long vol holder certainly bleeds quite a bit over time. One of my favorite charts to go side by side is if you look at the VXX over a 15-year period and then the XIV over its life cycle, they both effectively went to zero. Right? Long vol and short vol, just on different timelines and in different ways, but you wound up with basically zero in both cases. It's actually quite fascinating, I think. So there's a lot of ways to construct trades. There's just owning options that are short dated. You could own very far out of the money options. You can try to do clever things like contingencies to save money. You, of course, can use butterflies and so forth. So it's not to ask you what's the holy grail. It's to just hear you think through this. And as you think about your trade construction, the types of things that are in your process for trying to construct a trade optimally, just given what the vol surface offers at a given point in time?
I think this is a great question. And I think that especially someone who focuses on macro, it's really important because if I have a macro view, of course, I could express it in Delta One, but that's not really using the expertise I've developed over the years. And sort of anyone can do that, I guess, for lack of a better phrase. And so, my value add is coming up with the right structure. And I think that, my approach is, it goes back to the sports metaphor a little bit. You got to take what the market's giving you, right? So you see what the implied distribution is, you see what the pricing is, right? You have your spot level of vol, you have your skew, you have your convexity, you have your forward vol, right? Which I think is also really important. And then you understand the roll down, right? So my approach is generally, okay, here is the current price set. Here's what I think could happen. These are the different states of the world. And this is where I think, the market could be, and this is how the vol surface could be in these scenarios. And how do I think about the probabilities and how do I think about the value that I'm going to have if these occur? And I think that the pricing has a significant impact on that, right? So I wouldn't say that there's a single structure that's amazing, right? If if skew is high and you want to take a downside bet on the S&P, maybe you just buy a put spread because the payout ratio is, very good. On the other hand, if skew is really flat, then maybe you want to sell the put ratio so that you're capturing the wing and you think about, okay, how is the market going to react if we do have a down 4% day, right? So I like to just take advantage of what the market is offering based on current pricing and then compare that to, what I think the expected probabilities are of different states of the world.
We talked a little bit about rate vol versus equity vol, and going back to 2021, you'd made this really important point, which is this really rare combination of extremely low base interest rates of treasury yields and tight credit spreads at the same time, that being incredible for the corporate, an incredible opportunity to term out cheap debt. That period of very, very tight credit spreads was incongruous to the level of equity vol that existed post-pandemic. Maybe it was a holdover from all the capital that was destroyed in equity vol during March and April of 2020. But that was a good disconnect. A lot of people talked about credit spreads being tight relative to equity vol. I'm curious if you can just think through or talk through some of the other disconnects that you've seen where some asset or some implied vol measure relative to another asset that's at least a reasonable proxy for it that has been disconnected. And the kind of why of it. So whether it's FX versus rates or perhaps within equities where one asset, I know Nikkei S&P was a big variance swap trade. What are some of those disconnects that you've seen over time that would be interesting to hear about?
It's challenging because I think that anytime there's a disconnect, let's say that there's something that's, fifth percentile, and you're like, wow, the implied ratio is the fifth percentile. Well, there's probably a good reason for that, right? And the key here is to understand why. And oftentimes you'll find that it's where the spot is, that range. There's a lot of supply in whatever it is that you're looking at, right? So if you're talking about vol versus vol, and let's say that you're looking at yen vol, there's a lot of supply from corporates in this range. And then if it breaks that range, then vol can be very well supported, and it's hard to find an offer. And so I think understanding the dynamics that are behind it are very important. I think that, for the structure, you mentioned the structured product market. So I think when you're trading an index or a set of stocks that have structured products, it's really important to understand the impact there and where the key levels are. So I think that there's been many times where the first 15 to 20% down, let's say H shares, for example, the vol is going down because of the structured product impact, and you'll see vols and other things that are China related going up, right? Let's say, for example, AS51 or even dollar CNH. And then when you break through that range, then you get a real large, vol spike. I think H shares maybe, late 2015 was the best example of that, where you kind of got through the lower areas of the structured product vega, and all of a sudden there was no offer on the vol. So I think that you see these relationships a lot, but they're not always like an obvious trade. So to your point on the move versus VIX, I think that if you just look at the move, I think you have to really keep in mind that, the further you get from the zero bound, and I think you had Harley on here in a podcast before, and he's invented the move. So I think you described it that way, that, the closer you are to the zero bound, that the move index is going to be lower. And so as you're moving away, it should go up, right? And then I think that the distribution of outcomes are so much higher. And then you've also got this idea that, the Fed is, selling MBS. And so, now there might be a demand for convexity. So we have to look at a different time period maybe to think about how this ratio should be. On the other hand, and I think an interesting point is that the S&P now has a much larger amount of long duration assets relative to where it has in the past because of this outperformance of tech and, some of the underperformance of the other sectors that are more cyclical in nature or value stocks. And so I think that makes it actually different from some of the other equity indices in the world, and you're seeing it more reactive to rate moves. And so I think that, combining all these things, there's just been obviously so many dislocations over time, and how vols have moved. That's kind of my approach to really understand if this is an amazing trade or if it's actually going to get worse before it gets better.
Well, let's end here. Just have you share with us some of your views on where the vulnerabilities are. So the question is, if the VIX, let's say, went from the low 30s where it is now up to something like 50, which is pretty damn high, and I would say associated with something pretty close to a crisis. What's on your short list of things that went most wrong? What are the things that popped up that forced such volatility upon markets that the VIX actually got to 50?
It's hard to obviously know the unknown. So I think as far as, the likely unknowns here, I think that, certainly anything that would contribute to the stagflationary environment further would be a pretty big problem, right? And I think that if you see some of the impact of the Russia-Ukraine war, I think that, if you had similar concerns with what's going on in Asia, if there's something that disrupts supply chains or interrupts the way that a lot of U.S. companies are getting goods, and at the same time is negative for growth, and you get that stagflationary impact, I think that's a really big concern. We talked about or I alluded to earlier, if the Fed is unable to get inflation down with monetary policy, right, how much of a hit is growth going to take? And so I think that if they're not able to get it down and they feel the need to go well above neutral, then you are going to see a substantial growth effect. And I think that, could be something that we look at. And then finally, I think that if there's some, was it Orange County and was it 94 and of course LCCM in 98, is there someone who's holding a lot of risk that is exposed by the combination of rates up, equities down, credit spreads wider, and vol up? And is that going to have some sort of trickle-through effect to the rest of the market? You probably have a better answer for that than I do as far as what's likely there. But I think that certainly, gets you to, north of 50 VIX if it's any sort of systemic fragility.
Well, it was Warren Buffett who said, it's only when the tide goes out when you know who was swimming naked, right? So it takes a shock to realize when the positions might be overly leveraged or really wrong way, as you point to Orange County, LTCM, and so forth. So more price deterioration is just not good. Our markets these days are not built on self-correction. They just get worse when prices fall. They don't mean revert back. They get worse and they create all kinds of potential areas of spillover. So we shall see. But Vish, this has been a great conversation. I'm glad we finally got a chance to do it. And I really appreciate you being a guest.
Hey, thanks a lot, Dean.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.